Hello, I have been trading options for a few years. When I started, I found it very difficult to find the simple basics all in one place. Sort of options for dummies, which we all are at the beginning. I am by no means a guru, so do not take anything I say as investment advice, and do not enter any positions based on any one or two videos you find here. Options have a lot of moving parts, but once it clicks for you, it's pretty simple. So stick with it, you'll enjoy it. A put option gives the holder the right to sell a certain quantity, 100 shares, of an underlying asset, in this case a stock, at a predetermined price, called the strike price, at any time before the expiration date of the option. The buyer of the put option pays a premium to the seller for the right to sell the underlying stock at the strike price. This premium is a cost to the buyer and is non-refundable. If the price of the underlying asset falls below the strike price, the put option becomes in the money. This means the holder of the put option can sell the underlying asset at a higher price, the strike price, than the current market price. If the holder of the put option decides to exercise their right to sell the underlying asset, they will sell it to the seller of the option at the strike price. The seller is obligated to buy the underlying asset at the strike price. If the price of the underlying asset remains above the strike price, the put option will expire worthless and the buyer will lose the premium they paid for the option. That is why I personally prefer selling options, not buying them. More on that in another video. Now, in reality it usually goes a little differently. Most retail traders are not looking to actually buy the 100 shares to resell. By the way, all option contracts involve 100 shares of stock. I can't speak for commercial traders, but retail traders like us would much rather just sell back the option for a profit if it goes in the money, meaning the stock price drops below the strike price. Much cleaner and less fuss, take your profit and move on. The only thing better than making money is making money in the shortest time possible. In fact, the stock price does not even have to drop below the strike price for the option to generate profit. For example, if you bought a put option with a strike price of $40 when the stock price was $50, then days or weeks later the stock price dropped to $45 or $42, the option would most likely be worth more than what the buyer paid for it, and could be sold for a profit. The downside of outright buying a put option, or a call option for that matter, are that you are betting on that stock moving in a specific direction. If you are wrong, you will lose all or part of your premium. There are more factors involved than strictly stock price, such as time value and volatility, which we will cover in other videos to keep this information bite-sized. Thanks for watching. If you found value here, please like, leave a question or comment below and consider subscribing.